Welcome to our live stream overtime session. If you're new, these sometimes follow our Tuesday, if you're listening to this or watching this, our weekly Tuesday live stream Q&A. It's not always available, but more often than not, it is available. And it gives us a form where we can actually have a Zoom and get a whiteboard and talk about things a little differently than we can in that live stream. It's free, so you just register. First come, first serve. The maximum number of participants is 10. All right, so let's get started on what is in here. Whoop, anybody else trying to get in? Let's get a whiteboard. Erica, math on 66 is similar to math on 65. It's also similar to the same math at a lower level that you encounter on the series 7. And so all of this is called analytical tools. And so if you're struggling with some of the quantitative higher end kind of math, you definitely want to take advantage of the balance sheet questions that are on the exam. And there are some balance sheet equations in terms of math. I think, I was just talking to somebody the other day. This is basic arithmetic, and of your, 7 or 8 potential math questions, it's going to be 4, 5, or 6 of them. So if you pay the price to get this down, you can, be a little more forgiving on some of the other math. So you should definitely know the classical balance sheet equation. Does anybody know the classical balance sheet equation? Chat is open. You don't have to participate if you don't want to, but chat is open. If you want to put that, what you think it is there, that would be fine. I always struggle because I think of it as assets.
Hey, Dean, is it current assets minus liabilities?
No, that's called working capital. That's called working capital. So let's start big picture. By the way, this is testable on 2 levels because it's testable on the company level, but it's also testable on the customer level. We should be able to kind of have a general understanding of a balance sheet as it relates to a company or as it relates to an individual. Now here, Erica, what I sometimes get hung up on this because that's the way I think of it. And one of the challenges with math is there's a lot of ways to say the same thing. And so you just got to be careful. So when I see it expressed this way, I always struggle for a little bit. Assets equals, and that's why it's called a balance sheet, because it balances. So that's the same math, just said differently. So you just got to be careful about the math. Now let's start with what you just said in terms of getting to know my customer. So, for me to do a really good job for a customer over time, I'm going to want to know a lot about that customer. I say, listen, what I'd like to do is I'd like to sit down with you and do a personal balance sheet. I think if you get the personal balance sheet, then you can extrapolate it to the test questions about corporate balance sheets. And so, one thing I would want to know, Erica, is what is your current assets? Your current assets. Cash or things that you plan to turn to cash in 12 months or less. I'd like to know about your long-term assets. Things you don't plan on turning to cash quickly. A house, your car, that kind of thing. I'd like to know about your current liabilities. Things you need to pay in 12 months or less. I'd like to know about your long-term liabilities, maybe your mortgage, for example. Your car loan, those would be long-term liabilities. And what I'd like to establish is, what is your net worth? If we were a corporation, we'd be doing this every quarter. Maybe I say, well, why don't we revisit this every 6 months, whatever the case may be. Now, if it's a corporation, the current assets are going to be cash. And let's just say the corporation, I'll just make up a number, has 10 million in cash. I just made that up. Now, one of the challenges on your 65, 66 is they might give you these as ledger entries, and then you have to actually, put them in the proper kind of a sequence. So I'm saying it might be a little more complicated than just picking this out of the lineup, so to speak. Maybe I have prepaid expenses. I'm just making up some ledger entries. It doesn't really matter. what I make up here, except for in a minute. And let's say that's 5 million. I have accounts receivable. Money, people owe me money. And let's say that's 15 million. And we may have inventory. Now, one thing we don't want to have to do as a corporation is we don't want to have to, let's say we got 20 million in inventory. We don't want to have to turn our inventory to cash quickly because, we have to have an inventory reduction sale. We're not going to get as much for it. And so one of the concepts when we're thinking about liquidity, this is liquidity when you think about your liquidity. I embrace being an old dude and I joke, I like having a lot of liquidity. I'm one of those old fashioned Las Vegas guys. I have a binder clip. It's a binder clip, but I use it as a money clip. It's got a bunch of $100 bills in it, and I like walking around and, settling up with $100 bills. I don't have to run any plastic. Nobody knows my business. By the way, there's opportunity cost there because that's money that could be invested, right? It's also got inflationary risk because, my wad, I call it my wad. My wad might not buy me as much as it used to in an inflationary environment. But when we're thinking about liquidity, we don't want to have to turn the inventory into money quickly because we won't get the margin that we would like. And so one concept that we need to be familiar with is what's called quick assets. And that's where we don't count the inventory. We don't count the inventory. And so a couple ways to proceed here. Again, there's lots of ways to do math. I could total this up. Let's see if I can do the arithmetic. I'm terrible at arithmetic. So I think that's going to be 30. Would you agree we have 50 million in current assets? I don't know. I'm thinking that's what it is. I just made it up, but I think that's 50 million. Is that 50 million? You guys get the same math I do? That's the good thing about math. We should. Right. So there's our current assets. I'm simply totaling up the 10, the 5, the 15, there's 30, there's
30. 20. Oh, and the 20. Okay.
Yeah, 50s. And then we're going to minus the inventory, right? And so we're going to minus the inventory, which in our case is 20 million. And we get the quick assets of 30 million. Okay, so what would be some of our long-term assets? Remember, it's going to balance. Balance sheet's going to balance. In fact, let's just put that here to remind ourselves. Let's put this somewhere, right? We'll keep it up here, and let's give it a. So there's our quick assets. Let's label that. We're going to need that later on, kind of hint, right? So what would be some long-term assets? We could have a building, and land and building. Maybe that's, $40 million. We might have some intangibles like patents and brands. And maybe that's 20 million. Right. We might have some long-term investments. If this was a customer, maybe it's their retirement plans, whatever the case may be. All right, so let's go over here and talk about current liabilities. So current liabilities are things that you need to pay. So accounts payable would certainly be one of those. And let's say accounts payable is $20 million. So one thing you do get asked on the test, and let's see, anything else that would be current liability? I can't think of anything, but they're going to ask you the ledger entries, and you could just look at it and say, is this something I need to pay within 12 months? Right? If so, then it shows up here. But one thing you are going to be tested on is what's called working capital. We're talking about liquidity, and working capital. Test question is current assets minus current liabilities. Now, sometimes they don't ask you to actually do it. They just ask you to recognize it. So, they'll ask you to do it or they'll ask you to recognize it. And so we'll call that choice A. And I could say what best describes working capital, and you would, as a test taker, say current assets minus current liabilities. And then, on a bad draw, well, depending on whether you write the arithmetic, they might ask you to do it. So in our situation, our current assets was 50 million. And our current liabilities was 20 million. And so you would tell me on the exam that this company has 30 million in working capital. On a bad draw, on the face of death draw, they might ask you the effect on certain corporate actions on the balance sheet. And so one thing we should probably have a kind of a, high level view of is that once a company declares a dividend, it becomes a current liability. Once a company declares a dividend, so when the board declares a dividend, it becomes a current liability. So what would be the effect on working capital when a company declares a dividend? Declared dividends cause working capital to fall. Recently, Intel stopped paying their dividend. They said, until further notice, we're not paying any dividends because we need all the working capital we can possibly muster because we got lots of things that we need to spend money on. We need to generate liquidity. One way to generate more liquidity is to omit the dividend because that means we're going to have more money to spend. All right. Now, the other things they're going to ask us about are ratios. Ratio always means division. So if you can't decide what to do, you should divide. And if you can't decide what to divide, take the first number and divide it by the second number. And we're working on an answer set here. And this answer set is very testable. And as I told you, they're either going to ask you to recognize it, what best describes current ratio, or they're going to ask you to do it. And the current ratio is current assets divided by current liabilities. And again, we're making up this balance sheet as we go, so I don't know what it is. We said we had 50 million in current assets, and we have 20 million in current liabilities, so we just divide those. And let's see, I'll get my calculator out. I'll take 50 million, and I'm going to divide by 20 million. And I get 2.5 to 1. That's pretty good. So this company has $2.50 in current assets for every dollar in current liabilities. Not bad. They're not going to ask you bad or good. They're just going to ask you to either recognize the formula or perform the formula. I had a guy that was a serious math geek. He said, Dean, I'm not paying you to tutor me on math. Any two numbers I can solve for the third. So we're not going to be doing any math in my sessions. Good news, he passed, but he said, Dean, they didn't ask me to do the math. They asked me to recognize the math. That was a little more of a challenge for me because, he knew how to manipulate the number, but he didn't have the recognition of the formula itself. Now, remember, we don't want to have to sell off our inventory to pay our bills. And so a more stringent definition of the liquidity or calculation we can do is test question called the acid test or quick ratio. As I mentioned to you, we were going to need that quick assets to do this formula, right? And so we earlier had determined that our quick assets was 30 million. And so this is going to be the quick assets divided by the current liabilities. And so if we do that, again, I just made it up, so I don't know what it is, so we'll have to do it. 30 million divide by, everybody see where I got the 30 million? The 30 million I got from earlier. So you might have an intermediate step here, right? There's our 30 million that I'm getting to do this formula, right? And then we're going to divide by our 20 million. And let me get my calculator. 1.5 to 1, pretty good. Now, before I move on and talk about the capitalization of this company, because remember we said assets minus liabilities equals net worth or shareholder equity. And so before we look at that, do you have any questions about the math I've shown you thus far on the balance sheet?
No question.
Okay, so boom. So we always capitalize companies with common stock. There's no such thing as a corporation that doesn't have common stock. You know, when the company may choose to issue preferred stock, they may choose to issue some bonds. There's no such thing as a corporation doesn't have common stock. They may or may not have issued preferred stock, but they also might issue some long-term debt called bonds, right? So far, by the way, if we total up this side over here, we got 50, 90, we've got total assets of 110. And how did I get that? I simply totaled up the 50 million in current assets and the 60 million in long-term assets. So total assets is 110. So we already know that what's going to be over here, if we add up this side of the balance sheet, and it's called a balance sheet because it balances. So let's just put that here. Boom. Right, and we have here, we're working on this liability section here. And here we have our current assets. Here's our long-term assets. Okay, so let's say we have some bond money. Let's say we issue, so we have 110. So far on current liabilities, we only have 20. And so let's say we've issued $50 million in bonds. Remember, bonds are issued at par. So, you know, one thing I might want to know as a test taker is how many bonds is that? One thing I might want to know is how many bonds is that? So how would Dean go about determining how many bonds have been issued here? If on the balance sheet, I see $50 million in long-term liabilities, and I tell you, these are bonds and maybe they're maturing in 2043 is when they mature. Maybe they have an 8% coupon. I would divide the 50 million by par 1,000. That would tell me how the bonds are out there, right? And they're issued at par, and then they're going to trade in the secondary market at a premium, discount, whatever the case may be. You know, these bonds may be convertible. Let's say that these bonds are convertible at $40 a share. Well, remember, the other thing we got to be able to do is the conversion ratio, right? So we would take 1,000 divided by 40, and we'd find out that that's what, 25 shares. That would be something I'd be prepared to do on the test, is be able to figure out the conversion ratio. They're not going to calculate on 65, 66. They're not going to torment you about calculating parity on 65, 66 as they did on the 7. But they will ask you to recognize this idea of the conversion ratio. Okay, so we have $50 million in bonds. We have $20 million in current liabilities. So that means that our shareholder equity is $40 million. And how did Dean get the $40 million in shareholder equity? I got that 40 million by saying, okay, well, we have 110 on this side, right? And we have 20 million in current liabilities. We have 50 million in long-term liabilities. So we said they're going to balance, so we have 40 million. Now, last formula on this balance sheet, the last formula I would be prepared to do is debt to total capital. Debt to total capital. So the total capitalization, does anybody know what total cap is? The total capitalization of a company is the equity plus long-term debt, long-term liabilities, bonds is what that is. Let me get a smaller font. Let me move the pictures of you guys over here. That's called total capitalization. You know, some businesses require huge amounts of capital. Huge amounts of capital. Some businesses do not. So in our example, our equity is 40 million. And our bond money is 50 million. And so there is $90 million in total capitalization. And the last formula I would be able to do on this balance sheet is I'd be able to do debt to total capital. And so we're going to take our $50 million and we're going to divide. I'm just showing you different ways to use the divide sign, right? This time I'm going to put it on top. And again, this is not about liquidity. This is about solvency. The more money you owe, right, the less financial flexibility you have. I told you I like to have a lot of liquidity. I can't go bankrupt because I don't owe anybody any money, right? So again, that might be foolish, that might be conservative, but it makes me feel good, right? If I don't owe anybody any money, then it's life is good, right? I don't have to worry about anything. Anyways, I'll do this on this now. Again, this is called leverage. And leverage, remember, means the company is going to make money faster or lose money faster. Now, what this means is that of every dollar in capital deployed in this business, there's 90 million in capital. 55 cents belongs to bondholders. And that can threaten the solvency of the business, right? I always use as an example, Toys R Us. It's hard selling toys against Amazon and Walmart, but it doesn't help that they had billions of dollars of debt on their balance sheet. And when you have billions of dollars of debt on the balance sheet, then you need to sell a lot more toys to pay your bills, right? So any question on this balance sheet, these formulas? I think this would be the vast majority of the arithmetic that you're going to encounter on your 65, 66. Any questions on that? Okay.
The last formula that you did with
Yeah,
the 50
always,
and
yeah, right on. Hold me accountable. That was called debt to total capital. So the debt
Okay,
to total capital.
thank you.
You bet. So. Right. And that's called, what we arrived at was the debt to total capital. By the way, almost always division. Now you had asked about discounted cash flow. And so let's just clear our board. I'm about to clear the whiteboard. Anybody have any question on that before I clear it? Okay, so now discounted cash flow is going to be recognition. And what I'm interested in discounted cash flow, the classical example that everybody uses, well, maybe not everybody, but lots of people, is the idea of the lottery, right? Where, you win the lottery and they say, what do you want? Do you want $1 million or $10 million in one lump sum today? Or do you want $100,000 a year for the rest of your life? Now, I always joke that if I was confronted with that choice, I would call my friend Lee, who is a serious math geek. And I'd say, hey, Lee, I need you to do some math for me. I need you to do some math for me. I won the lottery and they're offering me either a lump sum, or they're offering me a set of income streams that I can't outlive, a set of payments for the rest of my life. And I'm not quite sure what is the better choice. And he says, well, let me do some math for you. And so when we're doing discounted cash flow, what we're simply trying to figure out is what would be a good value for a future set of income streams. what is that worth in today, right? So what we're trying to do is take those income streams and discount them back to come up with a present value of what we think they're worth right now. By the way, we're going to have to assume some kind of a return, some kind of stuff like that. Now, we typically are going to be discounting cash flow for first test question. You can only use discounted cash flow for investments that have income streams. So remember, the main things that we have that have income streams are bonds and stocks that pay dividends. So when we're applying discounted cash flow to stocks, it has a different name. Anybody know what it's called when we do it with stocks? It's called the dividend discount model. No, I always use Mr. Buffett, right? Mr. Buffett owns 1 billion shares of Bank of America stock. 700 million he got directly from Bank of America. And they bought 300 million shares in the secondary market. And Mr. Buffett says, wow, Bank of America, pretty cool, pays me 18 cents every quarter. 18 cents every quarter. So he has 700 million shares and he's trying to decide if he wants to buy some more. He said, well, I think what I'll do is a discounted cash flow and see what those future dividend payments from Bank of America would be worth today. And if I can get it for less than that, I'm going to buy some more. And if it's more than that, I'm going to say, I'll take a pass. And then he says, and, Bank of America may raise its dividend. Bank of America raised its quarterly dividend from 18 cents to 21 cents. Now, if Mr. Buffett assumes that Bank of America is going to raise its dividend, what is that called on the test? That's called the dividend growth model. Test question: what would justify a higher valuation? A higher valuation for a stock? If I assume the dividend is growing, or if I assume the dividend is not growing, what would give me a greater valuation? Growing dividend or not growing dividend?
Growing dividend?
Right on. That would be the test question. They'll say on the test, which of the following would justify a higher valuation for a stock? And you would say the dividend growth model. Another potential test question. Another potential test question. Can we apply the dividend growth model to a preferred stock? Can we apply the dividend growth model to a preferred stock?
No, because it's fixed.
Yeah, because it doesn't grow, right? So you can't apply the dividend growth model to a preferred stock because the dividend isn't growing, right? The dividend is going to remain the same, right? So that's definitely going to be something to worry about. How about a bond? Certainly we can do that with a bond, right? And then based on that price, we might be doing that. We might end up having, when we do it with a bond, either positive present value. What we mean by that is the bond's priced at 900 and we do the math and the future income streams are worth 940. In which case we'd say, oh, it's undervalued, we should buy it. Or the bond's priced at 900, we do the math. We're not going to have to do the math. And the bond's priced at 880 or 900 and we do the math, it's 880. We'd say it's overvalued. We would not buy it. Now, once you buy the bond, that number that takes the future value to the present value is set. And that is testable. What is the number called? If we actually buy the bond at today's price, we know it's a 10-year bond. We're going to get 20 coupon payments, and we know we're getting $1,000 at maturity. And then we're doing this, and we come up with zero, meaning it's priced perfectly. It doesn't have positive or negative present value. It's zero. What is that called? What's that number called? That's called the internal rate of return. That's what brings the future value to the present value zero, right? And they would ask that on the test as well about a bond. My main point would be don't get hung up. Don't get hung up on math, Erica, on 66. Brian and I talk about this all the time. It's something that gets you in trouble. It's just like margin on the Series 7. I can't tell you how many people spend hours on margin and it ends up being 2 questions. Now that's not a problem if you're still prepared, but it is a problem if you're not paying attention to other things. Customer accounts. Wendy wants to talk about customer accounts. Pretty straightforward, very testable. It's a target-rich environment on every exam. We should definitely know there's three types that I'll just highlight here very, very briefly. We have joint tenants with rights or survivorship. We have tenants in common. And very testable, we have utmas. And so let's go, by the way, these are test questions on every exam. So chat is open. Anybody tell me the difference? What you got to be able to do, Wendy, is contrast joint tenants with rights or what's that?
Joint flows across, tenants go down.
Well, I'm not sure what you mean by that. Let me just put it in my phraseology. With joint tenants with rights or survivorship, there is no fractional interest. Both parties own 100% of the account, and the decedent share goes to the surviving party. Very testable. Either party can act in the account. I see this a lot when I was a practitioner with husbands and wife, and it's their second marriage or it's their first marriage, and they go this way. Tenants in common, test question, there is a fractional interest, and the decedent share goes to the estate or beneficiary. So very testable, you're able to contrast those two. Uniform Transfer Minors Act is very, very testable. You need to know one minor, one custodian per account. Very testable. You can have multiple donors, but only one custodian, one minor. Test question, whose tax ID goes on the account? Whose tax ID? The kid,
child.
very testable, very testable. No margin, no margin. So let's just go ahead and let's just label these. Now, individual account, somebody on debrief, I think I told you about the debrief today. They got asked about what is transfer on death easiest to do for which account. That would be an individual account, right? Where you just tell us that you want this when you die, the account to go to somebody else. So no fractional interest. The other test question, by the way, about a joint account is all checks, disbursements are cut to the title of the account. So if that account says Mr. and Mrs. Jones, the check will be cut to Mr. and Mrs. Jones. And if they sell, then they're going to have to, both parties sign the certificate, for example. This seems just a fancy word for the dead person. By the way, this is testable on SIE. It's testable on, Series 7. It's testable on the 65. It's testable on 66. Same thing with UTMAs. When does the kid take possession of the assets? When do we re-register the account? Well, with UTMA, you can stipulate up to the age of 25. With UGMA, Uniform Gift to Minors, it's 18 or 21, depending on the state. All right, let's see what else we got. How do we now questions, Cynthia? I'm not sure. Is there any other account that you want to discuss, Wendy, besides these three ones that are very there? The other thing I'd be worried about is like corporate documentation. Like, for example, corporate accounts, we need a copy of the corporate resolution, which says which corporate officer can trade the account. If they want to have a margin account, it's got to be specifically permitted within the corporate charter. If it's a trust account, we need a copy of the trust agreement. So, that kind of thing. One testable distinction on 65 and 66 is that discretionary accounts by an investment advisor, we can use oral discretion before we have the paperwork in place. That is not true on the broker dealer side. That paperwork has to be in place. Does anybody know on 65, 66, how long an investment advisory firm can use oral discretion or authority without paperwork? It's 10 days, 10 days. So, there's some of those little distinctions like that you should be aware of. Now, I'm not sure, Cynthia, what you mean, how to weed out questions on practice tests. What do you mean by weed out? I need some more clarification on that.
Yeah, sure, Dean. I'd be happy to provide. I wanted to ask because I'm starting to feel like I'm ready to start my practicing exams and working on getting to know where I need to focus in on for the 7. When I took a Kaplan though, I have passed perfect, it's for full
Right.
discretion. But I took Kaplan first, and it's just one of them that Fidelity had to offer for
Yeah, yeah, I get it. Totally get it.
exam. And I didn't do as well as I thought I was going to, so it kind of scared me a little bit.
Well, don't be scared. You just got to embrace, you just got to be really resilient. So,
Yeah.
let's say you do below 60. I
Mhm.
wouldn't worry at all about my first practice test score. Wouldn't worry about it at all. And,
Okay.
I told you one of the reasons Erica is one of my favorite students here of late is, she responded well to negative feedback. I mean, that's tough. I mean, it's okay. I get it. Not every day is a great day when you're trying to get this thing done. There are bad days. And bad days could be, scores you're not happy with. You put in all the work and it doesn't show up in a practice test score. You still got to go for it. But I always say that first practice test score is just a mark. It really doesn't have anything to do with other than getting a starting point. So I wouldn't
Okay.
worry too much about that. Now, hopefully we get a score that we can work from. What I mean by that is we can't work from a score below 60 because, that just means we don't have enough base knowledge laid. We've got to go back to the books. We got to start doing chapter quizzes. We got to lay more base. But assuming we get a 60 plus, then we can work from that. And we can, again, we're not trying to learn by doing practice tests. Practice tests are to get marks. By the way, you can use them that way. I mean, God knows you can send me a question and say, should I worry about this or not? And I can say, yeah, you should worry about that, or no, don't worry about it at all. I thought Erica did another great job on that too. She sent me questions, and what I also like is she listened to me. I think she listened to me. Maybe she just humored me, but I tell her, don't worry about it, or worry about it. And I'm hoping that freed her up to go, go find more points that are available. What I call a cherry, Cynthia, is you want to pick the cherries and spit out the pits, right?
Yes.
The cherry, we want to get all our cherries. And what kind of my thing about past perfect, don't get me wrong, you're not at risk, but lots of pits. I mean,
A lot.
Definitely.
Definitely.
But sometimes, like I say, if you're a new test taker, you don't know if it's a cherry or pit or not, right? So
It's true. It's true. Even on the Kaplan, it's sort of like I think I mentioned in one of our overtime sessions, there was like a legacy question of recourse and non-recourse.
oh yeah,
and that was when I got wrong, and I'm like, oh man.
yeah, there's lots of, by the way, everybody's guilty of that. In my first podcast episode, I talked about that. It's because I get it. Nobody wants to call their cue back. For example, Cynthia, I had a guy today on the channel, and he said, this practice has been up here 3 years. I said, well, it is. It's one of the first things I ever put up when I started the channel. If I didn't think it was relevant, I would take it down. But, I'm just like the test prep vendor. I truly believe it's still productive or wouldn't be up. But that being said, if I take it down, man, I lose 60,000 views and, 100, nobody wants to, Kaplan doesn't want to say we had 3,600 questions, but we just culled it, got rid of all the legacy questions. Now we're down to 2,500. Nobody wants to do that. Right. So I've always told Kaplan, I would like the power to kill questions. Past perfect is guiltier than other firms on that, but they're all guilty. They're all guilty of what I call those legacy questions, making calculate yield to maturity. I keep trying to remind myself to keep a laundry list of them, because in my little podcast, I had a handful, but every once in a while somebody sends me another, like, that's another legacy one. I should write that down. So maybe someday I'll make another one and just say, here are all the legacy questions that I know are floating around. Do you, anything else on that, Cynthia? That's just get that first score. I worry about you taking too long to do it. You know what I mean? I don't know if there's a drop dead that your firm has imposed upon you to make you do it, but if you wait too long, it's hard because you're learning new stuff but forgetting old stuff, right? Somewhere is the happy medium, and I believe cramming is the right way to do it. What I mean by cramming is, pick a date 8-12 weeks out and do it, right? Just say that's my date certain. I'm gonna do what I have to do to reorganize the universe to make that work.
Okay, excellent. Thank
Suitability.
you.
So Diego, let's do that. Do you have anything else on that, Cynthia?
I'm all set. I'm just going to continue. I'll focus in on doing a
Okay.
past perfect exam, some of the Kaplan, and then get that mark like you said.
Okay, so the next thing that Diego wants to talk about is suitability options versus orders, and we can certainly do that. So let's get a whiteboard again. I like this one. Now, I would warn you, Diego, I might be a little overboard on this, but that's just me. Mutual funds on 66 are big. It's the same as your 7. Just, It's the same stuff, but they go a little more depth. I actually think that's one of the problems people sometimes make is they blow off mutual funds. Okay, so when we're talking about the option strategy versus the the order, we're usually talking about risk mitigation. The number one use of stop orders, there are others, but the number one use is to stop losses. Part of successful investing, Diego, is letting your flowers bloom, but more importantly, pulling your weeds. And so it's really important that you pull your weeds. So let's say that we're going to buy 1,000 shares of Apple. And let's just see what Apple's trading at. Apple has a high beta. Remember what that means? It means it moves a lot. And so 168 a share. Now, again, this is something, Diego, I believe that you should do. What Dean believes you should do is not testable, but if you're tracking money, I'm not going to put $168,000 in there. I think you should do things on a per share basis. I'll pull up that QID after we get this done. So there are two risk mitigation strategies here, Diego. One is to place a sell stop below 168. I tell my broker, if Apple trades at or through 165, send me home. And the other thing I could do is I could buy a put. You will not see it phrased this way. Yeah, you will not see it phrased this way. You come back, join me for a 9 or a 4, it will be phrased this way. But the option equivalent to a sell stop is buying a put. And the option equivalent to a sell stop is buying a put. The order equivalent to buying a put is a sell stop. So those are our two risk mitigation strategies for this position. Now, there are advantages and disadvantages to both of these. The advantage to the sell stop is you don't have to be approved for options. You can move it around and you only pay a commission if it trades. The disadvantage is once it gets triggered, Diego, we don't know what the next price is. The disadvantage of buying a put is you got to pay a premium. You have to be approved for options. You can't move it around, but you have guaranteed execution at the strike. So the other option position or other stock position we have is a short position. So again, it's about risk mitigation, right? So by the way, this would be the test question. So your point, Diego, this would be in an answer set. I just want to be clear. He's asking, they're going to give you choices of what you should do, buy stop or sell stop limit, and you got to come up with a sell stop, not a sell stop limit, because that may not get executed, right? And this could be in the context of an answer set for options, right? So this is not going to be 1 or 2. It's going to be within A, B, C, D, what would be the best risk mitigation. And now only on the test prep vendors test prep vendor questions do you get Roman numerals. So it would be, A, B, C, D, not a multiple of a multiple. And so again, you'd have to pick this out of the answers, that risk mitigation here. Don't be a dumb bear. I see Diego, let's enter a buy stop at 170. Let's say if Apple trades at or through 170, we're going to close out this short position. That should be not an A, that should be a stop. And then the other thing we could do is buy an Apple call. And again, you would have to pick this out of the lineup, so to speak. You'd have to be able to say which one would work, right? So boom, those are the ones that you need to do in terms of suitability. And then remember, the advantage of the buy stop is, again, you don't have to be approved for options to put a buy stop. And, you can move it around. And the buy the 170 call, you have to pay a premium, but you got guaranteed execution of the strike price. I can't imagine on any exam, 65, 66, so you're not going to have to recognize that that's the thing to do. Because if you do that, Diego, you no longer have unlimited risk. So, it's a great arrow in your quiver to know how to change a short stock position from unlimited risk to limited risk. So I can't imagine you're not going to be, asked to recognize that. All right. So, Diego, you have any other questions on that? Do you want me to go further on that, or I'm hesitating setting up a T or doing a practice question or anything like that. But is there anything else you want to know about that before I go on to our next one here? This will be our last one for the night. Okay, so QID. So let me see if I can bring up the QID. I don't have any tricks, Wendy, to memorize margin questions. I would know the classical margin equation. But again, you can watch the lecture. Don't overdose. If you tell me you missed the exam because of that, I'm going to say I don't believe you. But you had some other problem somewhere. All right, let's see if I can bring up the Kaplan Q Bank. I'm assuming, Cynthia, that's a series 7 question, right?
Yes. Mhm.
Okay, let me see here. Loading. Boy, man, if you were a test taker, that's got to be aggravating when you're trying to load the Kaplan Q Bank and it's not. Dude, I get the interruptions of the service message like, oh man, there's probably some test taker out there who's really mad. Yeah, let's see. I'm going to get the Q Bank here. Okay, what was that number? Can you just read it to me and I'll put it in here and we'll bring it up.
Sure. It's 126 4384.
1264384.
Yes.
Okay, so now let me find you guys. Full screen. All right, can you see my screen?
Yes.
All right, so here is the Kaplan question. A client is trying to decide between a par value corporate bond paying a coupon of 6 1/4. So the first thing you got to say to your mind is that 6 1/4 and it's taxable. This is very testable. It's 6 1/4 and it's taxable. And a par value municipal bond that pays 4 3/4. Assuming all other factors are equal and your client's in a 28% marginal income tax bracket, marginal has nothing to do with solving the problem. It says, what do you tell the client to purchase? So you're definitely going to have to do this on the test. And the way you're going to do this is you're going to either figure out the taxable equivalent yield or tax-free. So as I said with math, there's a couple ways to go. We always know that regardless of what we're going to do, this is very testable. The minute they give us a tax bracket on the test, we know that regardless of which way I decide to do it, I'm going to have to take 100% or 1, doesn't matter. I think of it as either $1 that I get, I have to give back 28 cents of the dollar, or 100 cents, 28%. I'm going to minus the tax bracket and say, okay, if you're in a 28% tax bracket, that's how much the US government is confiscating from you. I'm joking, but taxes, it's not a voluntary kind of a thing that you're making a contribution to the US Treasury, right? So a couple ways to think that. It's 0.72 or 72%, right? So basically you get to keep 72% of your money. So you say, well, Dean, 6 1/4 is better than 4 3/4. I go, well, I'm not so sure, Cynthia, because remember the 4 3/4 you're not paying taxes on, and the 6 1/4 you are. So we can either take the 6 1/4 times 0.72, or we can take the 4 3/4 and divide. So if I take by the way, here I'm going to go from the tax-free yield to the tax-free or taxable equivalent yield. As we said, you always want to be able to divide. And I said, regardless of which one you get, you're always going to have to do that number. That number is always going to be necessary. The 100% minus the 28%. And so now I'm going to divide by 0.72. And when I do this math, what I end up with is what's called the taxable equivalent yield. So I say, Cynthia, in your tax bracket, getting 4 3/4 and not paying taxes is the equivalent of, and I'm doing the math here, getting out my calculator. I'll actually put this one on the channel, Cynthia, because this is a real good one. So 4 3/4, and I'm going to divide by 0.72. And I say, Cynthia, in your tax bracket, getting 4 3/4 and not paying taxes is the equivalent of getting 6.6. And 6.6 is better than 6 1/4. And so you should buy the muni. You should buy the muni. Now, they didn't ask me to tell them what to do. Oh, yeah. What should you tell the client? We should buy the muni. Well, let me. Now, again, the other way you could have done this, is to take the taxable yield and figure after paying taxes, what is that? So we could take the other way we could have proceeded, a couple ways to do this. We could take 6 1/4 and times it by how much we get to keep. And how much of this 6 1/4 do you get to keep? Well, you're in a 28% tax bracket, so that means you only get to keep 72% of that. You know, we're kind of talking about like your take home pay, right? So I said, Cynthia, in your tax bracket, once you pay your taxes on 6 1/4, what's left to you is 4 1/2. And this muni pays 4 3/4. By the way, what I just did there is called the tax-free equivalent yield. This is very testable on all exams. You remember, Cynthia, what you tried to do, or where'd you get hung up on this thing?
Yeah, this is perfect. As I really got hung up on just some of the logic around like what was better and why it was better. So this is definitely helpful.
Yeah. So like I said, there's 2 ways to proceed. I like this, by the way, too, because it's a suitability question, which is a judgment question. Anytime we can use math to get a suitability question right, I go, ooh, that's wonderful, right? So once I think that the first kind of trigger for me as a test taker is the minute I encounter a question where they give me somebody's tax bracket. The minute I see a tax bracket, I go, that's where this is heading. And then I told you what I do as a test taker. I would just say, okay, I'm just right now going to take that. I know I'm going to need that because that's just what this setup is always about. So I'm just right away going to do that just to be done with it. Right. Because we're going to need that. By the way, 7.72 is the same as 72%. So that's what I would have done as a test taker. I'd say, okay, well, I don't know where they're going with this, but and whether I'm multiplying or dividing, because you're either going to go from taxable to tax-free equivalent, or you're going from tax-free to taxable equivalent. Equivalent meaning, what is it worth getting X taxable after you pay your taxes, or what is it worth taxable getting tax-free? So they're going one way or the other, right? So that's what I would do first. And then we said the next thing you got to do is say, okay, well, we got 2 yields here. We got a 6 1/4 yield that's taxable. And we've got a 4 1/4, 4 3/4 that's tax-free. And so now we're being asked, which should I tell the customer to do? As I said, you could have gone either way on this, right? You could either take the 6 1/4 in times. So when it's taxable, you're going to multiply, right? By the way, this is also on the 65, 66. So I hope you sevens who didn't forget all this stuff already, because there's some stuff that's going to be, and then here you would divide. So you're either going to multiply or divide, depending on, what they're asking you to do. Right. And you're going to multiply by 0.72 or divide by 0.72. As I said, that's always going to be part of that. All right, let's see what our friend Bill James is the guy in charge of Capital New Bank. Let's see what he said about this question. Sometimes the rationale is completely different than the way I explain something. Sometimes it's the same. Well, here we go. So this is calculated using the tax equivalent yield formula. Municipal yield divided by 100% minus the tax bracket. There's the math we just did. By comparison, 6.6 is higher than 6 1/4. Boom. Alternatively, so now he's showing you that you could have done what Dean did, which is do it either way. Any questions? That was a really good one, Cynthia. You're going to see something very similar to that on your exam. So any other questions? We went a little overtime on the overtime session here, Erica. Overtime on the overtime session. Erica's trying to say we should do a marathon one night where we just go into the wee hours. Doesn't speak to me so much. Anything else before we call it a night? There is a game. I'm letting it queue up right now, Erica. We got game one, LeBron versus Steph. I'm letting it queue up. Don't tell me if you know what's going on. I think it starts probably starting now, tip off. And then the first game, who was the first game? I think the first game was Knicks and Heat. So really some good basketball going on. All right. Well, if you have nothing else for me, remember, inch by inch, life is a cinch. Or I should say your exam's a cinch, yard by yard, it's hard. Yeah, it's some good basketball for sure. And then remember, if you are a participant in the live stream, this is completely free. But the office hours, I'll load up some office hours. That's for our paid alumni. And I will also put up some classes, some evening classes. Eric, I'll probably try and put up at least one 65, 66 hourly, session like we did in those others, because we haven't done that yet for anybody. So maybe we'll do that as something. I haven't decided, Eric. I got to look at my schedule and see when it works, because I don't want to do it on an evening when I'm teaching us a 66 or 7 already. So I just have to see what works on the schedule. Do you have your test date yet? You're 4-6 weeks out, I'm hoping. How long do they give you to give your 66 done? 6-4. Oh, plenty of time. So no worries. All right. Okay, guys, I will see you. There isn't going to be a session for next Tuesday, but I will load the session for the following Tuesday. So there will be no live stream overtime next Tuesday, but there will be one for the following Tuesday. Remember, first come, first serve. You can also, if you want, just send me what you want to talk about. You don't have to wait around for the chat. And, you can send it to me early and we can start there. All right, everybody, any last minute comments? Wendy, I do. I have a Series 7 class starting next Monday. You go to the Kaplan website. If you have any problem enrolling, just send me an email. I'll tell Kaplan to override it. It's capped at I forget how many people. But if you hit the cap, just let me know if you want to join me Monday, and I'll tell Kaplan customer service to override it and let you in. But that's Monday. It's 3 days, and I think it's 9 to 5. It's either East. I'm not sure if it's East Coast or West Coast time, but I'm listed as the instructor for that. Anything else? All right, everybody. I want some extra credit, Erica. We went 15 minutes over. We did a full hour on our overtime session tonight. So don't count on it, but we went a little bit over today. All right, everybody. I'll see you next time. Bye-bye.